Hey guys, hope you're doing well out there. Time to take a look at shares of Oracle Corporation, ticker symbol ORCL, as you have shares higher by nearly 13.5% in the after hours. That is on the heels of their Q3 results, which came out after the bell. As we walk through today's results, you'll see from a top line basis, this company really just has modest growth, but where excitement is really brewing is on their Gen 2 AI infrastructure, otherwise known as their cloud infrastructure. And commentary by Oracle is basically that demand is through the roof in this business segment, causing revenues to absolutely skyrocket as well. We'll also take a look at it from a chart perspective. This one was coming into this print basically on decision day and has broken through a key level of resistance. And if these gains hold in the after hours, you'll likely see Oracle make a new set of all-time highs tomorrow morning. And so we'll see some levels where I think you can come in and be a buyer in shares of Oracle. As always, if you're new to the channel and find this type of content valuable, be sure to hit that like and subscribe button below. It would be much appreciated. Shares of Oracle year to date up just 8.5%, but including these after hour gains, you'll likely have this one up nearly 20% on a year to date basis. Now we have top line revenues for this Q3 coming in at $13.28 billion. That was good for 7% growth year over year. It did come in line with analyst expectations and was 7% also on a constant currency basis. Currency not really affecting this business too much over the past quarter. In terms of a bottom line EPS figure, that came in at $1.41, did beat estimates by right around 3 cents. So both top and bottom line coming roughly in line with analyst expectations. Now, Oracle does provide their total remaining performance obligations, otherwise known as RPOs, and that came up 29% year over year, up to $80 billion. That is a new all-time high, which they mention in their commentary, and they expect 43% of those remaining RPOs to be recognized over the next 4 quarters, and that the Gen 2 cloud infrastructure will remain in a hyper growth phase, up nearly 53% in this most previous quarter, and will remain again in a hyper growth phase for the foreseeable future. And so that consists of their cloud infrastructure, which in this most recent quarter came in at nearly 50% growth on a top line basis. Still makes up a relatively small part of their revenues at just $1.8 billion, but it's really that growth on that cloud infrastructure side that's keeping investors excited. Along with that, another thing keeping investors excited is the partnership that Oracle hinted with the tech giant. You might have heard this name before, Nvidia. And so on the conference call, Oracle confirmed a partnership with Nvidia, and that next week there's going to release some details regarding that partnership. And certainly with a partnership with Nvidia, this is a company that basically has a two-sided partnership with Oracle, where Nvidia is a customer of Oracle, and then Oracle is in turn also a customer of Nvidia. And anytime you have a two-sided partnership like that, that usually bodes well for both companies, in my opinion. Now, in terms of the income statement, we have that $13.2 billion of total revenues. That was good for 7% growth year over year. We see cloud services taking off by roughly 12%, and that is the majority of their top line at roughly $9.9 billion. Oracle did see a contraction along all of their other business segments though, as you see hardware down roughly 7%, services down 5%, and then cloud license and on-premise license also down 3% year over year. But just the fact that your cloud services makes up such a big portion, nearly 75% of your revenues, and that grew at 12%, allowed Oracle to still expand their top line by right around 7%. Now, you also did have an expansion on your operating expenses, at least on that cloud services side. Now, this is something tend to not really like, where you have your operating expenses growing faster than your revenues, and you see operating expenses on that cloud services grew at 24%, whereas your revenues grew at just 12%. Now, what I think is giving Oracle the pass on this expanding operating expenses is just the fact that this is a highly intensive business from a CapEx basis, at least initially, while they're building out those data centers. That will take extreme capital investment in the early stages, and then hopefully as those scale out, you'll still see your top line revenues on that cloud services continue to expand with a lower CapEx spend on your cloud services. On top of that, you still have this business segment on very good margins. You see this segment at just $2.4 billion in operating expenses, generated nearly $9.96 billion in top line revenues. And so while your operating expenses as a percentage of revenues did go up, and your margins on this business might have come down a little bit, you're still sitting at nearly a 75% margin on this cloud services business. And so I think that also allows investors to give a little bit of a pass on expanding operating expenses on your cloud services business. Just the fact that this remains still an extremely high margin business from at least a gross margin perspective. And then on top of that, along the lines, you had Oracle controlling operating expenses on basically all of your other lines. You see R&D did expand right around 5%. And so your total operating expenses grew at just 4%, allowing your operating margins to also expand from 26 up to 28%, with your total operating income coming in now at $3.75 billion. Last year, you were closer to 3.26. And so you basically have this company expanding margins along their income statement from their operating side, as we saw, 26 up to 28%, and then also from their net income side, margins expanding from 15% up to 18%. And so when you see this company trading at roughly a 21 times forward earnings basis, and likely tomorrow closer to a 22, 23 times forward basis, historically compared to Oracle's past, that does seem relatively high, as this company trades historically somewhere in that 17 to 19 times forward earning basis. But as we saw, this company is expanding margins along the way, and it's basically a story that has been continuing over the last, I'd say, 2 to 3 quarters. And so anytime you have a company that's expanding margins along the way and that are proving to be sustainable, yeah, that will deserve a slightly higher multiple, at least on an earnings side, that I think Oracle is now looking to command. And so overall, I would say this is a pretty good Q3 income statement from Oracle. You have expanding revenues and then not as fast expanding operating expenses, allowing you to expand your net income. Where this company really does struggle, in my opinion, just a little bit at least, is from their balance sheet. They are sitting on close to $9.4 billion worth of cash and cash equivalents over the last 9 months. You see that hasn't really ticked down too much, and total current assets coming basically flat on a 9-month picture at $21 billion. This company does still sit on a ton of long-term debt though, and that is really where my concern lies with Oracle. You have nearly $82.5 billion of long-term debt, and then on top of that, another $5.5 billion worth of short-term debt. And really this long-term debt really does show up on your income statement. You see you generated nearly $3.75 billion worth of operating income, and you pay nearly $876 million in your interest expense. And year over year, that has come down, but still is nearly 25% of your operating income. And so this long-term debt does certainly impact Oracle's bottom line to, I'd say, a pretty fair extent. Now, you also have current liabilities coming in at $24.8 billion. That is higher than your total current assets, but with this company, keep in mind you have deferred revenues that they have to count as liabilities, which I believe over the next 12 months will eventually get transferred over to your assets, as this is basically services that Oracle has provided but hasn't yet received payment on. And so I think if you strip this out of their current liabilities, that from that perspective, your current ratio is still well over 1, and from that perspective looks good. But this long-term debt, I think, does carry a fair amount of risk, and in the form of Oracle having to pay that interest expense quarter in and quarter out, nearly 25% of their operating income. Certainly not something that I'm a huge fan of when it comes to Oracle. From a cash flow basis, this company is chugging right along. I would say $7.3 billion of net income. That's for 9 months ended last year. On a 9-month basis, you were closer to $5.2 billion. So your net income has expanded pretty substantially over the last year. On top of that, you have depreciation and amortization now starting to add up in a fair amount, as this company really looks to build out those extremely capital intensive and large data centers. You are going to be recognizing more and more depreciation on those type of assets. And then on top of that, you have stock-based compensation nearly at $2.9 billion. This is a company that really doesn't do a whole lot of buybacks. And so that stock-based compensation is something you as the investor will feel, at least to a little bit of an extent, in the form of dilution. As you see, your weighted shares outstanding did tick up on a year-over-year basis. And so stock-based compensation for a company that doesn't really mitigate that in the form of buybacks is something you as the investor tend to feel, at least over the long term. Now, your net cash provided by operating activities, otherwise known as your operating cash flows, at a pretty solid $12.5 billion. That is for the 9 months. And so you're looking at roughly a $4.5 billion operating cash flow run rate per quarter. Now, they spend nearly $4.5 billion in the form of investing activities over the last 9 months, and then spend another $8.2 billion in financing activities. And so basically their 9-month operating cash flows basically gets dwindled down in the form of investing and financing activities. They do purchase a little bit of their common stock, but just $1 billion over the course of 9 months, especially for a $300 billion company, really isn't moving the needle. The main form of their cash distribution, I would say, is in the form of dividends, as you have nearly $3.3 billion paid out over the last 9 months in dividends. And then you do see them paying back roughly $3.5 billion of their debt. But again, over the course of 9 months, $3.5 billion, not a whole lot, especially when you're sitting at nearly $80 billion of long-term debt. And so from a balance sheet perspective, you basically have pretty strong cash flows, but the fact that you still have to pay off a large amount of that debt, and then you're still paying a dividend, and the fact that now you're doing heavily capital intensive activities in the form of building out those large data centers, which I would say is a good thing. So not necessarily a bad thing doing all this capex on those data centers. You have this company using up all of its operating cash flows and not really able to add on to their cash pile, as you see over the last 9 months. That is basically flat on a year-over-year basis. So some things to like on this income statement. I think the fact that they are growing their cloud infrastructure business by nearly 50%. They have close to $80 billion in RPOs for the next 12 months. I think those are positive signs. But the fact that you still have a heavy load of debt on this company's balance sheet, I think that's something to poke a hole at when it comes to shares of Oracle. Now, in terms of the stock chart really doesn't care about how much debt Oracle is currently sitting on, as you see shares higher by nearly close to 14%. The last time we took a look at Oracle, they made this big sell-off on their last earning calls, down nearly 12%, and then even on their on their Q1 earnings call, also saw a large drawdown of nearly 10%. Seems like Oracle does tend to make these outlandish moves on their earnings call. It seems like in the short term, at least in the very near term, shares of Oracle are making a pattern of higher highs and higher lows. I think this is a company that has periods of consolidation and then continues to head higher. We see that over with Oracle, as you have large channels of higher highs and higher lows, and then for long periods of time, shares of Oracle don't really do anything and go sideways. I think you had that portion of consolidation really over the course of 2023, and it seems like now you're making this pattern of higher highs and higher lows once again, and seems like you have some room to run to the upside maybe before you hit your head with shares of Oracle. Certainly this strength in the after hours may carry forward, and also depends on what the partnership with Nvidia really looks like. I think this is something that is keeping investors excited with shares of Oracle, as you possibly could have a company in Nvidia that's looking to spend large amounts of money over long periods of time on a cloud infrastructure provider, and especially if it chooses Oracle as its sole cloud infrastructure provider, that probably fares extremely well for Oracle. In terms of looking at levels to buy, certainly I wouldn't be looking to pick up shares of Oracle on this massive spike up, but I think any pullbacks closer to the lower end of this range, near $114, $115, I think that's a level where you can inch into shares of Oracle, maybe open a position by picking up 1 or 2 shares. Certainly is in the form of an uptrend, and so I think that is your first opportunity to grab shares of Oracle. Certainly if this one continues to head higher, the valuation on this name will also continue to be pushed up, maybe closer to 25, 26 times. That is really where I would say Oracle is being priced to perfection, and you really want to pick this one up anytime it comes closer to that 20 to 21 times a forward price to earnings basis. And certainly it was there prior to this move, and on any pullbacks closer to the lower end of this channel, I think it can once again come back to that reasonable valuation and still would make sense from a technical chart perspective. I think you have some things to look forward to over at Oracle. The fact that their cloud infrastructure is doing extremely strong and demand is staying extremely strong. This is a company that's going to be investing heavily on capex in the form of expanding their cloud data centers extremely rapidly, and I think that is a good thing for Oracle to do. But keep in mind, it is going to be something that is extremely capital intensive, and considering this company has large amounts of debt, they probably can't take on too much more to finance those large data centers. That was my take on shares of Oracle. Not one I'm currently looking to get into, but maybe on any pullbacks, any meaningful pullbacks near the lower end of this range could be a level where I would consider picking up shares of Oracle. Let me know your thoughts on this one in the comment section below. As always, thanks so much for listening, and I'll catch you guys in the next video.